you, Sana. Hello, everybody. My name is Stephen Hines, and I'm joined here with my colleague Eduardo Morat. And we work in the credit rating agency policy team within ESMA. And I think we're very happy to see you guys here today. It's a good opportunity for us to discuss the consultation paper that we issued in December, which discusses how to integrate, how to improve the disclosure of ESG factors in credit rating actions. And I think before we go into the presentation itself, we might give you maybe a bit of background to the CRA regulation itself. It seems that some of you maybe don't come from that area, and it might be useful to give you an idea of the boundaries and the limitations that we're working in. So the credit rating agency regulation governs credit ratings within Europe, and credit ratings are limited to assessments of creditworthiness. And the problem with the regulation from the point of view of sustainability work is there is no mention of sustainability factors, sustainability risks. And so when we talk about improving the disclosure of ESG factors in credit ratings, it really has to be in the context of where they were relevant to a creditworthiness assessment. And in addition to this, there's also, a limitation both on ESMA, the Commission, and national authorities that there's no interference allowed within the CRA's methodologies. So it's not possible to mandate or require CRAs to consider sustainability risks, sustainability factors within their credit rating actions. So it's kind of within that context that we issued this consultation paper, which came out of the Commission's Action Plan for Sustainable Finance, which had, I think, Action 6, which you can break it down. It had a couple of actions for ESMA and a couple of actions for the Commission. For ESMA, there were two things. One was to integrate sustainability factors or consideration of ESG factors and credit ratings into our guidelines on disclosures. And in parallel, we were asked to produce a report on the level of consideration of sustainability risks, sustainability factors in the credit rating market. And alongside this, the Commission is considering whether it's necessary or exploring whether it's necessary to amend the CRA regulation itself to more explicitly require CRAs to consider these factors, these risks. And for both the ESMA tasks, we were given quite a short deadline of Q2 2019. This is something which we've been working on in terms of our own work, which we started on last summer, last quarter, Q3, and this gives you a little overview of the way we've tried to go about this. When we got the mandate, the first thing we did was we decided to issue a survey to credit rating agencies to get an overview of how they are considering ESG factors in general, how they've seen the market for credit ratings develop, and what they foresee in the next 5 years in terms of where they think it's going to go. And we used the responses to the survey for two things, for our two items. The first was to use it for the consultation paper and the chapter on ESG factors. And the second was to use it for the report, the status of the credit rating market. And from our point of view, this was useful because we wanted to see, well, what were CRAs doing at the moment? What were the common areas where we saw, okay, well, there's something which maybe we could improve here. It doesn't seem beyond the realms of their capabilities or beyond the realms of the regulation. Is this something which we can improve? And then it was maybe, an idea of promoting best practice. And this is what you've seen, with our consultation paper. We've tried to propose measures which we feel are achievable. We feel they are within the boundaries of the regulation itself and the legal constraints. And they also go some extent to improving the existing practice and improve the transparency for the user of the rating as to whether ESG factors were considered within a specific rating action. And it's with that in mind that we issued the consultation paper in December, and that's open for consultation right now. We would very much look forward to receiving your response to that. And especially today, I think we're most interested in hearing your views, not only on the consultation paper's proposal itself, but also maybe how you use credit ratings and how you see credit ratings fitting into this kind of the sustainable work of the Commission and the action plan itself. And so we're really happy to receive all of your kind of your input and considerations. This will be useful for us not only in the finalising the guidelines, but in finalising the report itself. So I might just give you a quick overview of the work that, or the chapter in the consultation paper that talks about ESG factors. What we tried to do is we've looked at, for each credit rating action, a CRA will issue a press release. And within that press release, there'll be a number of, say, legal requirements in terms of disclosures which they need to meet. And we figured this is probably the best place we can think of to improve the transparency as to whether ESG factors were considered, because there is a requirement that you explain the key underlying elements behind a rating action. So within our press release, we consider that it would be a good idea if, as a first step, you could provide a link to a guidance document or a link to a section of your website that explains, in a sort of general point of view, how the CRA's methodologies take ESG factors into account. So we know that the credit ratings will be limited to creditworthiness assessments, but it's possible to elaborate and explain how environmental, social, and governance factors are taken into account when they conduct these credit assessments. So we feel that would be a first step, at least for the user of the rating, to fully understand the boundaries and limitations of the rating itself. The next thing which we thought was useful was that the CRA would include either a positive statement or a negative statement as to whether ESG factors were a key underlying element of that specific rating action. So they could say that, perhaps the effectiveness of a credit rate of a rated entity's board was a factor in a rating action. If that CRA considered the effectiveness of a board to be a governance factor according to their methodologies, then they could include a positive statement to say that the effectiveness of a board, the board's operation was a factor in this rating action. We consider this to be a governance factor. And they could include a positive statement saying that, yes, ESG factors were a key underlying element of this credit rating. The last step will be that, obviously, if you include a positive statement saying, yes, ESG factors are considered, then the credit rating agency should expand whether the factor that was considered is either environmental, social, or governance. So with these sort of, maybe let's say, three elements, the user's rating has, let's say, they've got a good background with how that CRA considers ESG factors in general. They know whether the ESG factors were an element of that rating action, and they have a sort of listing as to whether that CRA considers that factor to be environmental, social, or governance. And taking those together, I think from our point of view, this is something which most CRAs, all CRAs should be able to achieve within the boundaries of not only the CRA regulation itself, but the methodologies which they work under. We're allowing for some flexibility in terms of positive statement or a negative statement. We're not saying that ESG factors have to be considered in rating actions. We're not saying that ESG factors have to be taken into account in their methodologies. We're only saying that when they are considered, you are a little bit more transparent about what was considered and how. And that's pretty much the proposal. So what we would like, from our point of view, the consultation opened in December, and typically our consultation we receive responses from CRAs themselves, but this is a good opportunity from our point of view to maybe get responses from a wider audience. So we're very happy to get your views in terms of this proposal itself, whether this will perhaps impact how you use ratings, or will it complement some of the other actions which are coming out of the action plan. So I'll leave it there and I'll take some questions.
My name is Elisabeth Robert. Can you hear me?
Yes.
I work for AFEP. AFEP represents 115 largest French multinational companies, and we've been working encourage you to go into the direction of greater transparency on ESG considerations in ratings. We believe it's absolutely fundamental because of the rise of sustainable finance and the fact that these ESG factors actually influence more and more investment decisions. Maybe I can give you the perspective of large French companies. We have worked on this issue at APEP, but also together with our partners MEDEF, CLIF, and C3E in France. And we are in fact publishing this week a manifesto for a better dialogue between companies and ESG rating agencies, and also presenting recommendations to the EU Commission. So this is exactly the issue of how to make this ESG rating process better. In a nutshell, we conducted a survey, a vast survey with 120 SPF French companies to ask them to assess the current practices of ESG ratings. And they assessed 9 major ESG rating agencies, index providers, and also data providers. And the survey covered 4 main subjects: governance, methodologies, the relation between the rating agencies and issuers, and also the handling of controversies, which is a very, very important issue for companies. And so 60 companies responded and allowed us to draw together a set of recommendations. Without going into too much detail, what companies want is to understand precisely on which grounds they are being rated. So they want to know the precise criteria for the ratings, and this is not always clear. There are best and good practices we are underlining, but it is not always the case. And so what we recommend is first to ESG rating agencies to adopt a code of conduct to precisely address the issues we recommend. So we will obviously send you the precise recommendations, and also we recommend to the Commission to propose a legal framework to impose minimum transparency requirements on ESG rating agencies. Now, obviously, your scope is a little bit different than ours because we dealt with ESG rating agencies. But I take this opportunity to raise the issue because I think the issue is quite similar, and probably there are some parts of our recommendations which could perfectly apply to credit rated agencies as well, which are more and more proposing ESG evaluations. So we think that the time has come to regulate ESG ratings in general, and so we encourage you to go into this direction of greater transparency. Thank you.
Sandy Frey, 2 Degrees Investing. I was part of the HLEG working on this topic, and the debate was pretty confused, I must say. And just for the background, we have been working with Moody's and S&P on the time horizon of their ratings, and with S&P to integrate climate risk in their framework. And we worked in general with supervisors, including EIOPA, on climate stress test for regulated entities. So my question is that I understand what you expect the credit agencies to report on is actually something that S&P is already doing, and my understanding is at least as far as Moody's is concerned, they will probably be open to do it. And so you mentioned the fact that you don't have a lot of resources. It looks to me that simply asking them to do that would probably avoid a lot of time spent on developing a regulation, because it's pretty straightforward and it's more kind of research paper than really ongoing compliance. When we on the topic itself, my understanding is they don't ignore ESG factors if they are material. They take them into account like every risk, and the only problem is the time horizon of the rating, which means that most ESG factors are not material if you focus on the next 3 years. and they tend to focus on the next 3 years and then extrapolate their cash flow analysis. And my understanding is that's the problem. So the question number one would be, would you consider adding requirements regarding more disclosure on the implicit time horizon of the ratings, and potentially guidance on what should be a relevant time horizon for the kind of in-depth risk analysis? And the second question is on this question of like to what extent ESG risk have been triggering rating actions. Why don't you just ask them to do that and see what they respond for the next 6 months? Because I guess it would not take them a very long time to do that.
Yes, go ahead.
Sarah Lovisori, Italian Stock Exchange, and thank you to the group. I see that the proposal is about unsolicited credit ratings. I see that is a new sort of asset class that is becoming popular or is on the rise. That is ESG-linked revolving credit facilities. So companies that are negotiating with banks revolving loans that are linked to the ESG ratings that is solicited though. So this ESG rating gets calculated every 6 months. And so I was wondering why limit the scope to unsolicited credit ratings and not proven.
Sure. Go first for some answers and then come back to
Yes, okay. Thank you. No, maybe to answer the first question, it's probably useful to say that there's obviously a distinction here between the limits of the CR regulation itself and maybe this other kind of element of sustainability ratings. So under the CRA regulation, under our supervision, it's credit rating agencies who issue credit ratings. And of course, I suppose these are maybe two different areas. At the moment, I suppose you've separate sustainability rating agencies who deal with something which is something other than credit risk, and you've CRAs who deal with credit risk. And for the moment, our regulation, our supervision is focused on the credit rating agencies themselves. But of course, we're always interested to get comments and inputs. We would like to receive your views. On the second question, I suppose, in terms of it's more, at this stage we're issuing guidelines to improve current practice. So it'll be, I suppose, it's a question for the Commission as to whether they want to go further than the regulation goes itself. So really it's for the Commission to assess and to consider whether they want the CR regulation itself to say something more about sustainability risk factors than it does at the moment. But you're right that at the moment it's about the key driving factors. They need to disclose the key driving factors behind a credit rating. And it's possible that an environmental and social or governance factor will be a key driving factor behind a credit rating. In which case, that's where we would see these guidelines becoming relevant. So where it is a key driving factor or a key underlying element, then these kind of disclosure steps would, I suppose, kick in. And that's, I suppose, that's how we see it working under the current framework. It's limited to credit risk, but of course, when these factors are relevant, that's where these things will come into effect. In terms of, I suppose, the practice, I mean, what we've seen is that yes, some CRAs are doing some of these elements already. Others are doing maybe one or two, kind of more. What we felt was that what could we do with the existing regulation? We could try to bring everybody up to the same level. And if we had everybody at the same level, what we consider to be, about as far as you can go within the regulation itself, then that would be an improvement over what is going on right now. If we could have a sort of consistent industry standard, that would make a difference. But of course, depending on the Commission's views, they may wish to amend the regulation to either explicitly integrate sustainability factors or not. But I suppose from our point of view, that's not something which we're really getting into at this stage. On the final question, our consultation paper really deals with both solicited and unsolicited credit ratings. I suppose there's two chapters to it. There's one chapter which tries to improve press releases in a general perspective, and that's the first one. And we have got some proposals in terms of how you improve the transparency of the solicitation status and the participation of the regulatory. But then there's this chapter which talks about ESG factors in general when they are considered within the press releases what you do. But we would see it as applying to both solicited and unsolicited ratings. So it should, we wouldn't kind of result in sort of subdivision of the press releases or any kind of I suppose covering only a portion. We'd see it as covering all rating actions where ESG factors are considered or not. That's the purpose, I suppose, of the negative statement, so that if they were not considered, you would still have something in there which gave clarity to the user as to whether ESG factors were not a key element of that rating action. But I think that answers all the questions.
Okay, sure, yeah.
Michel Lebpetit from the SHIP project. First comment. I would say it would be difficult for CRAs to have all the means they should need to cope with the low carbon transition if their own country where they're based is out of the project. So I would propose to the rulers, and I should ask the ESMA to look at what would happen if these credit agencies were prohibited in Europe because of the country leading the Paris Agreement, as some of these countries have proposed. One would say it would be a pity because they are quite able and they are knowledge in these large credit rating agencies to cope with it. I'm not really pleased by what happened 10 years ago with the previous crisis. And even though they have knowledge, I'm not sure that much knowledge about the condition risk we have to cope with. The second point is about methodologies. Your text say that methodologies that are rigorous, systematic, continuous, and subject to validation, including by appropriate historical experience and backtesting. And I would ask ESMA to look with its rulers about this sentence, historical experience and backtesting. I think it's not possible regarding climate change. There is no historical data to provide anything of what we're going to live in the few years coming from now. So I propose ESMA to look at change in its own regulation and propose something to the rulers. Your proposal is interesting, but it's a little bit like cosmetic.
My name is Carlos Wong from AM Best Ratings Agency. Just a couple of questions about the consultation paper itself. Can you hear me?
Yes.
One is about the relevance of the ESG factors. So you talk about the relevance regarding a rating action. A rating action can be just a review, can be an affirmation. Say one of the examples that you mentioned is related to governance, for example. And it's very difficult if we just talk about, say, the general credit rating assessment. It would be very difficult to argue that governance is not a key element. But not in most cases we have governance actually being a trigger for a rating movement. And in that example of governance in the consultation paper, it refers to a rating movement. So I'm not sure if in this case you're actually talking about credit rating assessment in general, including affirmations, or only rating movements. That's one. And the other one is the disclosures refer always to the existence of a press release. If there are cases where there is no press release, or we have other documents where we disclose information related to that rating action, like a rating disclosure form, say the key assumptions, or the credit report, say is that the intention that everything has to be in one place? I'm just trying to think about specific cases where we may not have a press release specific to that rating action, especially when we have affirmations again.
my name Federico Cornelli, Italian Banking Association. I would like to go back to my French colleague point. As banks, we are very much happy to provide money and loans to, say, ESG people and try to shift and reduce carbon. And when as we have no taxonomy, we have again no data sets from the past. So every kind of back testing that we have tried on a sample of any kind of taxonomy has no data at all. So the example the French colleague gave is quite useful, I think.
Yes, thank you. I might answer the first question. So, to give you maybe a bit of context, in terms of issuing credit rating agencies within the EU, I suppose you do need to have a legal entity within the EU. So we would consider that any credit ratings issued within the EU are issued by an EU CRA, and then all of the requirements of the regulation should apply to them. And this includes the methodologies. This is, I suppose, something which comes up quite a lot, and certainly came up in the responses to the survey in terms of the time horizons of the rating themselves, and I suppose the difficulty of considering, I suppose, environmental or climatic events in those credit ratings, which typically are maybe considering something between, I suppose, 3 or 5 years. Yes, it's something which we can think about. I think it's something which is relevant for the Commission when they're considering kind of amending the regulation itself. It's something which is relevant, I suppose, to bring the CR regulation to a place where maybe it's a bit more, I suppose, in line with the work which is going on elsewhere under the other action points. But for the moment, I suppose, we're limited from interfering with the methodologies themselves by this non-interference clause, and really all what we can do from our perspective is to, I suppose, to assess whether they are employing methodologies which are rigorous, such as back testing, etc. It's difficult, I suppose, from our point of view in terms of going further than that, given the limitations of the regulation. But it's something which is relevant. It's something which we consider, for the report to the Commission in terms of if it's relevant for their consideration for amending the regulation itself. I suppose the next question was to do with the press releases. This is something which I think we're quite open in the constitution paper itself in terms of the regulation doesn't really mention press releases. This doesn't really crop up. It's more we've seen that the press release is a kind of an industry standard in terms of meeting the general obligations when you issue a rating action, that the press release is kind of a vehicle by which you would meet your kind of general disclosure obligations. Let's say there's 10 general disclosure obligations, and it's easiest to do it through this public press release. And so it's something which we felt that if we're going to recommend some kind of additional disclosures here in this area, that this press release, this kind of accepted industry standard, that's probably the best place to do it. And in terms of when we would see it occurring, we would see it when there is a rating action. So currently when you are publishing a rating action, this is where we would expect you to make these additional disclosures. So we're really trying to, I suppose, improve the existing standards. I'm not saying that you should be making more disclosures than you are currently doing. We're not saying that that there are instances where you should be issuing press releases or you're not. It's more when you are issuing a press release on the foot of a rating action that you should include these additional disclosures.